Everyone's talking about how the Bank of Japan held rates at 0.75% last Friday, but here is the number nobody is mentioning. The 10-year government bond yield just blew past 2.3% for the first time since 1998. The market isn't listening to the central bank anymore. It's listening to the fear of a snap election.
2.3%? That's a massive gap from the policy rate. And welcome back to Asia Tech Macro. I'm Maya, looking at these trends through the eyes of a founder who needs stable capital. And with me is Alex, who spent a decade at a hedge fund and still believes that every central bank announcement is just a polite suggestion.
Because usually it is. But seriously, today we are diving into a volatile week. We've got the BOJ's steady hand being challenged by bond traders, Samsung's desperate pivot to HBM4 to save its Nvidia relationship, and India's final push toward its $300 billion electronics target by the end of this year.
It's a huge week. I was just reading this morning that Prime Minister Takaichi, calling a snap election for February 8th, has sent the ultra-long bond yields above 4%. Alex, as an analyst, how do you value a tech company in Tokyo when the risk-free rate is moving this fast?
You don't, at least not with a traditional DCF model. You look at cash flows. But here's what most people miss. Despite the bond volatility, the BOJ is still signaling a clear path toward future hikes. They are trying to normalize in the middle of a political storm. It reminds me of 2022, when the Fed started hiking. Everyone thought it would kill tech, but it only killed the weak players.
Okay, but devil's advocate here. Doesn't this uncertainty kill the Japan revival narrative for foreign VCs? I saw that foreign investment in Japanese tech startups actually dipped 4% last quarter.
That's just noise, Maya. The big money is in the 1.23 trillion yen semiconductor budget. That's locked in. But speaking of big money, we have to talk about the earnings showdown on January 29th. Samsung and SK Hynix are entering the ring for the HBM4 era.
I saw the reports that both companies have already delivered paid HBM4 samples to Nvidia. It's for the Vera Rubin platform launching in June. Samsung's stock actually rose 2.2% on the news, while SK Hynix fell about 3%. Is the market finally betting on a Samsung comeback?
Well, actually, let me rephrase that. The market is betting on an end to the monopoly. SK Hynix has controlled over 60% of the AI memory market for years. Nvidia wants Samsung to succeed because they need a second source. But here's the reality. SK Hynix 2026 production is already sold out. They have the contracts. Samsung only has the samples.
That reminds me of what happened in 2023 when everyone thought Samsung would catch up in 6 months. It took them 2 years. But here's the question for our listeners. If you're building an AI data center right now, would you pay a 20% premium for the reliability of SK Hynix or take a gamble on Samsung's new HBM4 yield? That is the multi-billion-dollar question. And it's not just a technical one, it's a contractual one. SK Hynix has already locked in most of the high-end capacity for the rest of 2026. If you want the Nvidia gold standard, you almost have to wait in line at Hynix.
Exactly. It's a seller's market. But speaking of supply, let's pivot to the other side of the Indian Ocean. I was just reading this morning that Ashwini Vaishnav, India's IT minister, was in the Netherlands on January 23rd, literally 3 days ago. He confirmed that 4 of India's major semiconductor plants are on track to begin commercial production this year. We're talking about Micron, Tata Electronics, CG Power, and Kaynes Technology.
Wait, commercial production in 2026? I remember the skepticism when the India semiconductor mission launched in 2022. Everyone said it was a pipe dream, that India didn't have the clean room culture or the water infrastructure.
Well, actually, let me rephrase that. They are starting with pilot production and moving to commercial by year-end. Tata's plant in Assam is scheduled for pilot production by mid-2026. But here's what most people miss. This isn't about competing with TSMC on 2-nanometer logic. This is about trailing edge and specialized chips. It's about power electronics and sensors for the domestic auto and telecom sectors.
That reminds me of what happened in 2023 when the world realized that a $50,000 car could be held hostage by a $2 power management chip. If India can secure that base layer of the supply chain, they insulate their massive domestic market from the next global shock.
True, but let's look at the bill of materials. I saw a detailed proposal from the ICEA, the India Cellular and Electronics Association, submitted to the PMO on January 10th. They've identified 16 key products, including laptops, tablets, and intermediate components like PCBs and lithium-ion cells that they want to localize by the end of 2026. They are projecting a cumulative private sector investment of over 1.1 trillion rupees.
1.1 trillion rupees? That's roughly $13 billion. And they want to hit a $300 billion electronics production target by the end of this year? Alex, as a numbers guy, does that math actually work? We're currently at what, 115 billion?
It's a vertical climb, Maya. To get from 115 to 300 billion in 12 months requires more than just factories. It requires a total overhaul of logistics. I saw a note from Rydam Desai at Morgan Stanley last week. He's calling this a secular growth story, but he admitted that India is currently in a mid-cycle slowdown due to election volatility and erratic rains.
Okay, but devil's advocate here. Isn't the India hype reaching a saturation point? I saw that foreign direct investment into Indian manufacturing actually slowed down in the final quarter of 2025. Is the China plus one trade getting exhausted because the infrastructure just isn't keeping up?
That's a sharp question, and the answer might be in the logistics data. I was looking at the time-to-port metrics yesterday. Vietnam is still beating India by a significant margin for high-turnover electronics. If you're Apple or Dixon Technologies, every hour a shipment sits in a warehouse in Tamil Nadu is money evaporating.
That's why you always see those emergency cargo flights. But wait, if India is struggling with the physical, they are dominating the digital. I saw that their digital public infrastructure is being exported to half a dozen other countries now.
Digital is easy to scale. Concrete is hard. But let's move to the geopolitical black swans we're watching for 2026. I saw a report from Wellington Management on January 21st. They're highlighting that the US-China competition is now moving from tariffs to investment screening and data sovereignty.
Data sovereignty. That's why Singapore is suddenly the center of everything, isn't it? I saw that drone taxis are finally making the Singapore-Jorhaus Causeway travel time less than 15 minutes. It's the electric air taxi era.
It sounds like science fiction until you see the funding. But here's the macro risk. As these regional hubs like Singapore or Tokyo become more autonomous, we're seeing a fragmentation of the global order. I saw a dumb AI trigger a $1 trillion market sell-off last December because of a bad sentiment analysis algorithm. We are building a world where the speed of tech is far outstripping our ability to regulate or even understand a risk.
That reminds me of what happened in 2023 with the first wave of LLMs. Everyone was so excited they forgot about the hallucination risk. Now we have agentic AI running entire logistics chains in Southeast Asia. If the agent gets the geopolitical temperature wrong, it could stop a production line for a war that isn't even happening.
Exactly. Which leads us to our contrarian corner. Maya, what is the consensus truth that we need to deconstruct today?
The consensus is that Japan is back because of the yen and the corporate governance reforms. Every newsletter I read says the Nikkei at 45,000 is just the beginning.
And let me guess, you think the floor is about to drop out.
Not the floor, but maybe the foundation. Look at that 2.3% bond yield we talked about earlier. If the risk-free rate in Japan continues to climb because bond traders are betting against the BOJ, the entire value trap that investors thought they escaped is going to snap shut.
Well, actually, let me rephrase that. The value trap has been replaced by a political trap. Prime Minister Takaichi's snap election on February 8th is a referendum on the yen. If she wins big and pushes for more fiscal spending, the yen stays weak, but the bond market revolts. If she loses, we get a stronger yen and a tech sector that suddenly loses its competitive pricing edge overnight.
That's a lose-lose for the Goldilocks scenario. So the contrarian move here is what? Short the Nikkei and buy the yen?
No, the contrarian move is to realize that the Japan revival was never about Japan. It was a hedge against China. If China's golden yen trade framework, which they just announced in Davos, actually gains traction for settling oil and tech trade in the global south, the US dollar loses its status as the safe haven of choice in Asia. Japan becomes a secondary player again.
Wait, the golden yen? I saw that quick take from Saxo Bank. They're predicting a massive challenge to dollar dominance this year. If the RMB becomes the settling currency for Asian tech, the entire carry trade doesn't just unwind, it evaporates.
Precisely. It's a tectonic shift. Okay, let's get to the action items, because our listeners are probably checking their brokerage apps with trembling hands right now. So what should you actually do?
Action item 1. Watch the commercial production milestones in India this quarter. If Micron or Tata actually hits their yield targets by June, the manufacturing hub narrative is real. If they delay again, the India hype is a bubble.
Action item 2. Check your sovereign AI exposure. Don't just buy the chip makers, but buy the companies building the local data centers in Malaysia and Vietnam. The direct counter-purchase agreements we talked about are the key to long-term margins.
Action item 3. Hedge for the February 8th election in Japan. If you're heavy on exporters like Tokyo Electron or Advantest, you need to be prepared for a 140 level yen. The 0.75% Mirage won't last forever.
And finally, stay data-driven. Don't trade the headlines, trade the bond yields.
Great stuff today, Alex. Next week, we're going to be talking about the digital baht and why Thailand is suddenly leading the charge in central bank digital currencies. It's not just about payments, it's about state control.
I'll bring the cynicism, you bring the coffee.
Deal. Thanks for listening to Asia Tech Macro. Don't forget to hit that subscribe button and check the show notes for the analyst reports we cited today.
See you next week. Stay data-driven.
Bye.
Goodbye.